As industries evolve faster than ever, companies need an environment that accelerates strategic growth, and Michigan delivers on that promise. From emerging startups to global enterprises, Michigan offers what executives value most: a resilient, innovative ecosystem, diverse communities that attract top talent, and a quality of life that supports work-life balance. With our unified Team Michigan approach, businesses scale faster and compete at the highest level. Michigan, pure opportunity. Seize your opportunity at michiganbusiness.org.
Small businesses are the pulse of every community. They bring people together, create opportunities, and drive growth. Chase for Business helps business owners like you with personalized guidance and convenient digital tools all in one place. With that guidance and your determination, you can take your business farther and help build a brighter future for your community. Learn more at chase.com/business. Chase for Business. Make more of what's yours. The Chase mobile app is available for select mobile devices. Message and data rates may apply. JP Morgan Chase Bank, N.A. Member FDIC. Copyright 2026. JP Morgan Chase & Company.
Travel smarter, not harder, at America's Best Value Inn by Sonesta. With convenient locations from coast to coast and value-packed comfort at every turn. It's a practical choice for road trips, quick getaways, and everyday travel that keeps things simple without sacrificing comfort. And when you're a Sonesta Travel Pass member, staying at America's Best Value Inn means earning points toward free nights, upgrades, and more every time you stay. Go to Sonesta.com to book your stay and unlock the best rates with Sonesta Travel Pass. Here today, roam tomorrow. Join now at Sonesta.com. Terms and conditions apply.
Welcome to Inside Active, a podcast about active managers that goes beyond soundbites and headlines and looks deeper into their processes, challenges, and philosophies in security selection. I'm David Cohne. I lead mutual fund and active research at Bloomberg Intelligence. Access to markets has changed dramatically over the past decade. Strategies that were once hard to reach are now being delivered through ETFs, models, and new structures designed to scale. But as access expands, it raises a different set of questions about capacity, outcomes, and whether making something more accessible changes what investors actually get. Today, I wanted to explore what that means for active management and how the industry is balancing innovation with discipline. Joining me to discuss that is Anna Paglia, Executive Vice President and Chief Business Officer for State Street Investment Management. Anna, thank you for joining me today.
Thank you for having me.
So let's dive right in. Do you think the industry has moved past the whole active versus passive debate, or is it you think it still has a useful framing?
Oh my goodness. I really hope that the industry is now past the active versus passive debate because as you may know, I'm sure that you know it really, really well. We have been talking about this for the last 30 years. Active versus passive, which became mutual funds versus ETFs. Ultimately, is not really an either or, one is better than the other, is really a matter of understanding how to use active strategies and passive strategies when building a portfolio. I also think that the industry did a lot of really good work educating clients, educating investors about the differences between the content and the technology. The ETF wrapper is a technology. It's not a content. It's just the mean by which content is delivered to investors. Now, historically, ETFs were only passive, hence the debate, active versus passive. But in the end, the ETF wrapper is just a phenomenal technology that is really upgrading the way by which we deliver content to our clients.
So if we go a little further, do you think passive has gone too far anywhere where it's actually made markets less efficient, creating opportunities for active?
I don't think that passive has gone too far. I think that passive is doing exactly what the passive is designed to do. Passive was born as market exposure in a way that is cost-effective, tax-efficient, and allows investors to get a slice of the market. Passive is really meant to be predictable, So the way you allocate passive to a portfolio is using a rule book. I don't think passive has gone too far. I actually think that there are other opportunities for passive to continue to innovate, even if the market is becoming more and more crowded as we go.
And so if we kind of talk about how, active and passive both have places, do you think that clients still have a misunderstanding of active management today, what they're actually asking for that, doesn't necessarily lead to better outcomes?
Well, David, returns are incredibly important. And I do believe that active management is struggling not because of the legal wrapper, but because the benchmarks are incredibly strong. We have seen several years of very strong equity markets, especially US domestic equity markets. And it has been really hard for active managers to outperform the benchmarks. So I do think that investors are driven by the outcome, they are driven by returns. And at a time when it's really easy to go in and out of a fund or to trade ETFs out of digital wealth platforms, returns are becoming incredibly important. I don't think that investors have the patience that they had before to say, well, the active strategy is underperforming. I'm going to wait for the explanation. I'm going to give it another year, 3 years, or 5 years. We live in an environment in which investment choices are at the fingertips of our investors. And I think that the patience of long-term investors that we saw in the last decade is slowly evaporating and showing very strong returns, showing a very strong strategy that generates alpha is the key between an investor choice between an active strategy and a passive exposure product.
So one of the things we've noticed is, especially kind of this kind of rebound in active management, where passive was kind of dominating for quite a while. And, obviously the ETF structure helps a lot. It's, investors prefer that. But, we kind of looked at fee compression as another issue that I think has kind of helped active along. Do you think that fee compression has improved the quality of active management, or, is there kind of a flip side where, it's less revenue and could make it harder to, invest in talent?
The way I look at that is really simple. Investors are winning here because these active and passive ETFs and mutual funds, the dynamic that we have been observing, especially in the last decade, really showed that for active managers to outperform their benchmarks and to have a favorite allocation within a client portfolio, they have to show competitive fees and they have to show outstanding performance. And I'm not just talking about, top half or top 1/3. You have to show very good, strong performance, top decile to begin with. So to me, in this competitive environment, investors are really the winners because everything is fully transparent. Fees are right there. You can get a slice of the S&P 500 for as little as 2 basis points. And if active managers cannot beat the S&P 500 and charge more than that, it's going to be really, really hard for that strategy to have a favorite place in a client portfolio. However, the other thing that is happening is that really strong asset allocators are winning. We have seen that the new flexibility and the exemptive orders that the SEC has approved have opened the door to active strategies finding a place in the ETF wrapper. We have seen that with mutual fund to ETF conversion. We will see it more and more again with the ETF share classes of mutual funds. So strong active strategies based on fundamentals with a very strong track record wrapped in a very modern technology like ETFs is really going to continue to thrive. And we have seen the results last year where $580 billion of net new assets in the ETF industry were really originating out of active strategies, either through conversions or new fund launches. Now, not all active strategies are created equal. Again, performance is paramount. It's not a coincidence that there is a big difference between the growth of fixed income active ETFs and the growth of equity active ETFs. In fixed income, you can really use very thoughtful and very strategic active portfolio management strategies to outperform most of the benchmarks. And this is why active fixed income is growing faster than active equity. But in the end, performance is really going to drive flows.
So if we talk about, why active ETFs are doing so much better than active mutual funds, but can you think of a reason which would make an active strategy work better in a mutual fund as opposed to an ETF?
Well, there are a number of reasons for that. I'm not saying that the ETFs are always the best possible wrapper for a given strategy. The first thing that you have to look at is capacity. We, at State Street Investment Management, we operate a wide platform where we are very much wrapper aware. And I don't like to see wrapper agnostic because I think wrapper agnostic is a little bit of a mistake. Wrapper aware, being wrapper aware, it's really important. We offer our capabilities through ETFs, mutual funds, CITs in separate mandates. So for us, it's really relevant. We don't have a view about what wrapper is best for a certain strategy. But what is really important is, one, what the client wants, what type of clients we are going to offer strategies to, and capacity. Ultimately, when we make a decision about launching an ETF, we always have to ask ourselves, what happens if we become the victims of our own success? What happens if this fund becomes widely successful? Are we going to be able to operate this strategy at $50 billion, $100 billion, over $100 billion? Because unlike mutual funds, you cannot close an ETF. You cannot suspend the redemptions. The ETF is going to have to continually trade. The ETF is going to have to be open for business and provide daily liquidity. And if there are strategies based on maybe concentrated strategies or securities that are less liquid than what you would like to see in an ETF, then the ETF may not be the best wrapper. Again, it's not the one and the other. There are some nuances that you have to take into account during the product development process.
If we go a little deeper on that, if as asset managers think about capacity and scalability, and especially for firms that haven't made the move yet, how do flows play a role? I guess even something like model portfolios, which can drive flows at scale. How do you think about that when it comes to capacity?
Yeah, well, you have to think about capacity under many different lenses because our product innovation journey is not just at the manufacturing level. So capacity is not just about building a fund, launching a mutual fund, or launching an ETF. If you are launching an ETF, you have to think about how is this product going to be consumed. Model portfolios are certainly going to play a role that is going to be more and more important in the next 3 to 5 years because technology is making it possible for small clients to use model portfolios. And ETFs play a big role in there. But I'm also thinking about direct indexing. Direct indexing and those, tax alpha generating platforms are using ETFs. Some of them are also using mutual funds, but most model portfolios that we see are really using ETFs as building blocks. So you have to look at many different dimensions of liquidity, many different dimensions of flows. How much of the flow do you expect to come from model portfolios, from direct indexing platforms, or from digital wealth? That's the other distribution network that is growing faster than wealth and institutional. And those investors do not buy mutual funds, they buy ETFs. So what type of strategies do you want to put in market? And are you reasonably sure that the combination of wealth, institutional, model portfolios, direct indexing, and digital wealth is not going to cause this fund to lose its liquidity and, the strength of the wrapper may be compromised?
That makes sense. If we switch gears just a little bit, I just want to talk about launching active products. And, when you're evaluating a potential launch of a product, for you, what separates a real need from just, product proliferation?
That's such a good question because last year we have seen a lot of product proliferation. I believe that the ETF market saw something like 1,077 new products coming to market in 2025. But of those products, only a handful were able to cross $100 billion in $1 billion in the first 12 months of their life. And the reason for that is pretty simple. Launching products is easy. Launching the right products is not really easy. And I do think that those sponsors, those asset managers that are able to generate that type of growth are asset managers that do not innovate for the sake of innovation. They are able to step away from these vanity projects where, I have a great idea, I can manage a great portfolio, so I'm going to build it and they will come. Build it and they will come really doesn't work in ETF land. And for what it's worth, it doesn't even work in mutual fund lands. So we have pretty much moved away from manufacturer standpoint. Whenever we start a product innovation journey, we don't start from our own capabilities. We start from the other end of the process, which is the client. Everything is very much data driven. We look at flows, we look at bottom-up assessment of what we hear from clients on the ground with, we have a very strong sales force, boots on the ground, every day talking to clients and bringing that intelligence back into our innovation hub. And whenever we assess gaps in market, this is where our process starts. It doesn't start from the manufacturing side, it starts from our clients. And then we work backwards. We try to build that capability, and we also ask ourselves, are we best in class with this? We have built a playbook that is really successful when it comes to partnerships. We don't have to be best in class at everything. We know exactly where our strengths are. We know ETFs, we know liquidity, we know secondary markets, we know primary markets. This is very much the strength of our platform. But if there are things that we are not really great at, we don't have an issue saying we are going to call a friend here and we are going to partner with somebody who is best in class at this particular thing. We partnered with Bridgewater to bring us into ETFs. We partnered with Apollo to bring private credit to ETFs. We partnered with Galaxy to bring digital assets into ETFs. So for us, it's really about filling a gap and then working backwards to understand who has the capabilities to deliver that outcome.
So if we think about the next wave of innovation, do you think it could be coming from asset classes like private markets or how I guess you'd say strategies are packaged and distributed?
Yep, I don't really look at asset classes versus strategies. Again, we look at investors' needs and we follow the money. Because when you follow the money, you are never wrong. You know exactly what clients are buying, and it gives you an idea of what particular themes they are focusing on today, but may drive flows in the future. And those themes may be low cost, it may be income, If you look at the biggest drivers of flows in the first 4 months of this year, which is also something that we have seen in 2025. So this is not just a change in trends. We see that half of the flows come from low cost exposure. I don't know if this is going to change when markets start to crack. I mean, right now we have had the luxury of living in a period of strong equity markets. So low cost has really been a driver. 50% of the assets are really originated out of the desire to have a slice of the market at a very low price. Income is the need for income, and not limiting that to dividends is what has really caused and propelled the proliferation of the income-oriented products. So we have seen many of these examples in market, but also we have seen buffered ETFs really taking a fair share of flows last year and this year, stemming from clients' desire to control the downside a little, even if they are compromising the upside slightly. So what we do is really move away from asset classes and really look at these themes. Asset class specific, if I really were to go there, I would tell you that the fixed income is a big focus of ours, because we do believe that active selection matters when it comes to fixed income, and we will continue to look at opportunities to innovate in active fixed income, both through mutual funds and ETFs.
Okay. I do want to focus on one asset class, though, for just a second. I do kind of want to go back to the private markets, because products like PRIV are just really interesting to me, and trying to bring less liquid exposures into a more accessible wrapper. I'd love to know, and my listeners would love to know, what had to change, I guess, internally to make something like it possible?
That's a really good question. Two things have to change: price transparency and liquidity. Now, when we started working on PRIV, the industry is really 50-50. But when we started working on these funds, we formed a number of beliefs. Belief number one is that private markets and public markets will converge. We have seen this movie before. We have watched it. It sounds like a repeat of what we observed with senior loans, emerging markets debt. Those markets were inaccessible, illiquid, and then slowly that liquidity was created and markets converged. And we do believe that this is the beginning of the journey between public markets and private markets. We also formed another belief, which is, especially when it comes to private credit can still command higher yields compared to the more traditional public side of credit. And we also believe that quality matters. So selection matters. Not all private credit is created equal. And when we built this fund, we really thought about a fixed income exposure that provides outperformance compared to the benchmark, with the inclusion of a private credit component. Now, our partnership with Apollo really helped us make ourselves comfortable when it comes to the liquidity. So Apollo is providing a liquidity backstop to the funds. So in cases in which we decide that we want to sell those assets, Apollo has agreed to buy them back. Apollo is also giving us price transparency. We get 3 quotes a day on each one of those assets from Apollo. We value those assets internally, independently of Apollo. And we also hired an independent data vendor because we were not satisfied with the first 2 sets of data. So we converge all of these different data points, and we come up with a pricing that we believe is indicative of the value of the security. And we put that price on our website. Again, the transformative thing about this product is that we are providing a level of transparency about these assets that did not exist before. And 30 years ago, when the first ETFs were launched, what we discovered was that transparency enables arbitrage, and arbitrage makes everybody honest. So, I mean, we have seen this fund, first of all, delivering the results that we expected to see. Right now, the fund is outperforming its benchmark in a way that is meaningful. We are talking about 90, 95 basis points, depending on the period. And we are really satisfied and pleased with the liquidity of the assets that we include in the private segment of the portfolio. So we didn't go 100% private because we don't think the market is ripe for that. We don't think that there is enough liquidity to support a fund that is 100% private and provides daily liquidity. But we do believe that we are at the beginning of that journey. And that journey is going to end in 3 years, 5 years, in a place where we are going to have price transparency, we are going to have liquidity, and investors will really be able to take advantage of that. I mean, in the end, the mission of ETFs over the last 30 years has been one of democratizing access. It has not been passive. I mean, people always equate ETFs with passive. That's not the mission of this product. The mission of this product is breaking down barriers, democratizing access to financial instruments. And democratizing access to the active performance of private markets is going to be the next frontier of this market.
But for now, if investors are looking at PRIV, should they consider that a fixed income exposure where they're getting access to both public and private, as opposed to, an alternative allocation in their portfolio?
Yeah, that's a really good question. We don't consider that an alternative allocation. We built this fund and we continue to market this fund as a reinvention of Core Plus. We really looked at the Core Plus category. We didn't want to do a Core Plus Plus, but we said if we are able to incorporate these additional yields to this portfolio, we will be able to reimagine Core Plus, reinvent Core Plus. So this is not going to be something that fits the alts bucket in a client portfolio. To me, this is a complement to the fixed income exposure, where if you are looking for a Core Plus allocation, this fund is going to give you Core Plus, the same risk profile or a similar risk profile of traditional Core Plus strategies, with the added benefit of the additional private yield.
Okay. One thing you had mentioned is democratizing the markets. And I guess my question is, how does active management fit into that mission, just given its, I should say, historically higher cost structure? I mean, obviously fees are going down, but I guess how do you view that as part of it?
Yes, well, alpha is paramount. Usually when investors look at returns, they look at returns net of fees. So if you can deliver outstanding returns net of fees, fees are going to become irrelevant. I mean, ultimately, fees are really important if you are producing mediocre returns and the fees are eating up on the returns. This is what investors are going to look at: the S&P 500, 2 basis points. And this is what I get. I get the performance of the S&P 500. I only have to pay 2 pips for that. But if you have strong active management, I am an ETF geek. So everybody looks at me as the passive girl. But I am not at all a supporter of passive. I am a supporter of good performance and good returns for our investors, because this is our purpose. This is why we do what we do. And if active managers can generate outstanding alpha, can beat their benchmark, and can provide net of fees outstanding returns for their clients, they can charge as much as they want. But if they cannot do that, they are going to have to, come down to what the ETF lens suggests as being the average price or the median price for a certain strategy, and they need to be able to deliver those returns of those fees. The market is becoming more and more competitive, but we continue to see active strategies being deployed in an ETF wrapper that is not just single-digit advisory fees. So good performance can command higher fees.
So if we, I guess, separate the active equity and active fixed income, because when I look at managers in aggregate, it's actually the same thing with ETFs and mutual funds. The active fixed income managers tend to do a lot better. They have a lot. It's easier for them to outperform the benchmarks versus the active equity. And if we're thinking about active management over the next decade, do you think it's kind of a performance issue that they need to stay relevant, I guess?
It is 100% a performance issue.
Yep.
If I were an active manager, I would be much more focused on performance than on fees. Because, again, the benchmarks are incredibly strong. We had, and the benchmarks, passive benchmarks, are by no means passive. There is no such a thing as pushing a button and portfolio rebalances. Index providers put a lot of thought, technology, and strategy in the build out of an index. Indices come in so many different shapes and forms where the line between active and passive is becoming very blurry. Where do you put systematic indices? Where do you put smart beta indices? It's a combination of dynamic strategies, rule-based approach, and transparency. So with the indices evolving so fast and benchmarks being so strong, the true active managers, the real ones, are gonna be the ones that can generate alpha. And it's not impossible. Last year, 1/3 of active managers beat their benchmark in the equity side. In the fixed income side, it was around 45 or 47%. So as you said, in active fixed income, there is a better opportunity to beat the benchmark. But beating the benchmark is paramount.
Okay. Well, I think this is a great place to end, but this was a lot of fun, Anna. Thank you so much for joining me.
Thank you for having me.
I will also want to thank our listeners. If you liked the episode, please share, subscribe, and leave a review. And if you'd like to see more of our research on the terminal, please go to BI Fund Go for fund and active research. Until our next episode, this is David Cohne with Inside Active.
If you follow markets, you know the value of long-term thinking. You plan, you diversify, you prepare for volatility. But even the best strategies can't prevent every bad day. For more than 75 years, Cincinnati Insurance has helped individuals and businesses navigate tough moments with expertise, personal attention, and independent agents who focus on relationships, not transactions. The Cincinnati Insurance Companies. Let them make your bad day better. Find an agent at CINFIN.com.
These days, it seems like AI agents are just about everywhere you turn, every field and every function. But without identity, you can't trust they'll serve your business instead of jeopardizing it. Fortunately, Okta helps you get identity right by securing your AI agents' identities, giving you a single layer of control, a single standard of trust. So whether an AI agent supports a single user or your entire enterprise, with Okta, you'll turn risk into opportunity. Secure every agent. Secure any agent. Okta secures AI.
A business gift should do more than check a box. It should reflect your brand and show someone they're appreciated, recognized, and truly seen. 4imprint offers thousands of high-quality, customizable products, like premium apparel, drinkware, tech, and more, making it easy to create a gift that feels meaningful and on brand. And with 4imprint's expert support and their 360-degree guarantee, you can be 4imprint certain your order will arrive exactly as intended. Explore gifting with confidence at 4imprint.com. 4imprint. For certain.